All right, welcome back. Let's move on to Chapter 12. I think for most of you, Chapter 12 is probably, or at least the information in Chapter 12 is probably what you had in mind when you signed up for the investments class. The topic of Chapter 12 is fundamental analysis of companies and stock valuation. How do we place a fair, appropriate value on a company and on its stock, one share of its stock? I think the most important chapter in the investment class is the chapter on asset allocation and investment policy statements. That is the single most important decision in asset allocation that individual investors have to make. But if you're interested in picking individual stocks, or if you're working for a company and your job is to look for other companies or pieces of other companies to buy for your company, or if you're considering putting your company up for sale, it's going to be important for you to be able to determine what a fair price is for your company if you're trying to sell it, or for another company if you're trying to buy it. And so we're going to take a look in this chapter at how professional investors value companies and value stocks. So let's move on. So how do we value a company or a stock in a capitalist economy? Let's take a step back and revisit capitalism. An economy is a system that creates and distributes products and services, employment, prices, and wealth. So all these things that are so important to our lives are determined by an economic system. Okay? Most economies are mixed. That means they contain some combination of capitalism and government control. Capitalism is based on private ownership of wealth and private decisions about investments, which is capital allocation, how to allocate the capital that a country or a system has. Individuals base their investing decisions primarily on life circumstances, where they are in their lives, in terms of age, wealth, income, and risk appetite. So these are the factors that individuals, these private individuals that make these investment decisions, this is what we consider. And we also take a look at the risk and return profiles of the investments that are available. So we try to match up where we are and what our wants and needs are with the investments that are out there for us. Okay? To assess the risk and return profiles of investments, individuals rely first and foremost on fundamental analysis. Fundamental analysis has two dimensions: company analysis and valuation analysis. Fundamental analysis of companies involves identifying and studying the factors that determine if and how private enterprises will operate. Okay? Should we operate our companies? Can they be profitable enough? And how will our companies operate? What's our business model going to look like? Fundamental analysis of companies focuses on, but is not limited to, variables like products, services, technology, market size, distribution methods, labor availability and cost, industry structure, barriers to entry, cost inputs, and management track record. These are just some of the things that we analysts look at when we are trying to assess a company. Fundamental valuation of companies and stocks involves assessing the cash flows of the companies that we're considering, and really more importantly than the cash flows when we're doing valuation, because cash flow analysis is really part of fundamental company analysis, but it also bleeds over into valuation analysis. More importantly, we look at the discount rate or the multiples to be paid for the cash flows that we're thinking about buying. Okay? Fundamental valuation focuses on, but is not limited to, variables that impact discount rates and multiples, like the business models, the growth rates of sales, earnings, and cash flow, asset utilization, are we running the business efficiently, leverage, how much leverage are we using, is it appropriate, the returns that we're earning, risk premiums that we should pay, financial market developments that might impact what people are paying and what people expect to earn in the form of a return on an investment, and interest rates. So these are some of the more important things that investors look at as we try to determine how much to pay for the cash flows that we are buying. All right. Much of fundamental company analysis is done using marketing analysis and then financial statement analysis. So those are the two things we use, we employ, we pursue, we conduct when we're doing fundamental company analysis. We're looking at markets and we're looking at financial statements. Marketing analysis is critical because it focuses on all aspects of the products and services, and the customers, and all points in between. This includes this marketing analysis, but is not limited to what products and services to offer, what features and traits to design into our products and services, what prices to charge, how to advertise, how to engage and retain customers, how to distribute our products and services, how to create a defensible, competitive position for our company, determining how large the market is, and lastly, ascertaining what our market share might be. Marketing analysis determines our sales forecast and many of our strategies and our costs. All right, let's take just a brief pause and animate this. I'm not going to stop because I've already stopped once and restarted this thing, and so let's just go ahead and animate this thing real quickly. I'm telling you, it's always something, but that's okay. We're going to get this thing going. Here we go. All right, just a brief 20-second pause. Let's go. All right, so financial statement analysis involves computing historical financial ratios that look at profitability, asset utilization, leverage, and returns. So now we're shifting from marketing analysis to financial statement analysis, and these are the items that we really focus on with our financial statement analysis. The goals are to understand critical variables for a company. As we're trying to put together our company and run our company, what must we pay close attention to? We must understand the trends in these variables. We must understand and project cash flows, and we must understand the risks associated with our company. All right. Common size statements are a critical component of fundamental financial analysis. Then we do peer and trend analysis of various financial ratios. Okay? And to do valuation analysis, we're going to study historical and current market prices, multiples, and investment returns. So we're going to dive deeply into all of these areas in this chapter. All right. Common size financial statements involve converting each line item of a financial statement into a percentage, primarily by dividing those line items into sales. We looked at this very quickly in managerial finance. There are some line items on the income statement that do not directly relate to sales. For example, interest expense is not a function of sales, it's a function of debt, which is a function of management decisions about capital structure, and interest rates. These are the things that affect interest expense, but we're going to go ahead and divide them into sales. Similarly, tax rates are not a function of sales, they're a function of pre-tax income and tax rules, not necessarily sales. So be careful when putting together common size financial statements. Since most financial statement line items will be driven by sales, the first step in projecting financial statements is to project sales. And we're going to do this in just a couple of slides. All right? Once sales are projected, most of the other line items are simply a function of sales. But care must be taken to study trends and to research the prevailing circumstances for each line item. We're going to talk about this in more detail. Our goal is to make accurate forecasts. So we've got two more slides here. Many of the financial ratios that help explain a company's financial condition and performance are generated by common size financial statements. And the categories of financial ratios are, as we mentioned earlier, profitability. These are the things that analysts look at. Gross profit, operating profit, net profit. Asset utilization, okay? We'll be looking at accounts receivable turnover, fixed asset turnover, inventory turnover, and total asset turnover. How are we using the assets that we've purchased? Then we look at leverage. How leveraged up are we? What is our ability to pay our debt and our obligations? We'll look at the current ratio. Debt as a percentage of total capitalization, cash flow coverage, and the degree of financial and operating leverage. Okay, then lastly, we'll look at returns, and we'll focus on return on assets, return on equity, and return on invested capital. As we're doing our financial analysis, these are the ratios that we pay close attention to. All right, now all of these ratios here are ratios that we analysts take a close look at as we are trying to determine the financial position or condition of a company and the operating performance of the company. These are the major ratios. These are not all the ratios, but these are the major ratios that we will look at. And I'm not going to go over them in detail because we've had them before. All right, we're going to take a brief pause and then come back and do more fundamental analysis. Until then, peace out. Shalom.